You're deep in a trade, it's bleeding red, and every instinct is screaming, just add a little more, it'll bounce back. Minutes turn into hours, and suddenly, you've doubled your position in a sinking ship. Today, we're tackling the trader's trap that quietly destroys accounts, and the sneaky psychology behind doubling down on losers. If you've been trading for more than a few months, you've probably been here. You buy a stock, crypto, or Forex pair. It drops. Instead of cutting the loss, you convince yourself it's a bargain now. So, you add more. It drops again. You add again. Before you know it, your small position has ballooned into a massive exposure on something that keeps heading in the wrong direction. It's the trading equivalent of digging a deeper hole because you're sure you'll hit treasure soon. Spoiler, usually you just hit more dirt. This habit, doubling down on bad trades, feels logical in the moment. After all, if you liked it at $100, shouldn't you love it at $90? But in reality, it's often a dangerous mix of loss aversion, ego, and a refusal to admit we were wrong. In this episode of Trading Psychology Pitfalls, we're going to break down why traders keep falling into this trap, how your brain tricks you into thinking it's a smart move, and how to build a mindset that avoids this spiral. We'll explore the psychological biases at play, real-world examples of how this kills accounts, a step-by-step way to prevent it from wrecking yours. And yes, we'll talk about the difference between strategic scaling and desperate averaging down, because they are not the same thing. Before we continue, I want to thank the sponsor of today's video, Noesis. Noesis is a platform built specifically for traders who want to level up their consistency and mindset while avoiding mental pitfalls. It gives you tools like a daily mental check-in, a trade journal, and an emotion wheel to track your state while trading. On top of that, it includes structured playbooks, which are strategy checklists that you can go through before and after each trade, plus a playbook marketplace where you can explore proven strategies from other traders or share your own. If you're serious about developing the psychological edge that most traders ignore, Noesis is worth checking out. You can get started today at noesis.zone, link in the description. The seductive logic of averaging. Down on paper, averaging down looks brilliant. Your break-even price drops, so you need a smaller bounce to get back to green. If you bought at $100 and it's now $90, adding more means maybe you only need it to rise to $95 to break even. Here's the problem. Price isn't falling for no reason. Every drop is the market telling you something. Maybe the fundamentals have shifted, maybe momentum's gone, or maybe your timing's just off. By ignoring that information, you're assuming your initial thesis is perfect and the market is wrong. That assumption has bankrupted more traders than bad luck ever has. Think of it like doubling your bet at a casino blackjack table. Yes, mathematically it can work, until the streak goes against you longer than your wallet can handle. The psychology behind the trap. Let's be honest, nobody plans to double down on a loser. You don't wake up thinking, today I'm going to ignore my stop loss and add more to a sinking position. No, it happens because our brains are wired in ways that make this behavior feel rational in the moment. Here's what's really going on under the hood. Loss aversion. The pain. Multiplier. Loss aversion isn't just a theory from behavioral economics. It's something you feel in your gut. Studies show that the emotional impact of losing $100 is roughly twice as strong as the joy of winning $100. In trading, that means you'll do almost anything to avoid the emotional sting of locking in a loss. So instead of selling and realizing I was wrong, you buy more, telling yourself, this way, I can get back to break even faster. It feels like you're fighting back, but you're actually tying yourself to the very anchor that's dragging you down. The sunk cost fallacy. Throwing good money after bad. Once you've committed time, research, and capital to a trade, walking away feels like a waste. That's the sunk cost fallacy. Your brain keeps saying, I've already invested so much. I can't stop now. Imagine paying for a movie ticket, realizing 20 minutes in that it's awful, but staying until the end because I paid for it. In trading, that ticket price can turn into an account-crippling loss, especially when each add to the position is just you buying more movie tickets to the same terrible show. Ego and confirmation. Bias. I will be right. Cutting a loss isn't just about money, it's about identity. If you pride yourself on being a smart trader, admitting a mistake can feel like a threat to your self-image. Ego whispers, you're not wrong, the market is. Confirmation bias then plays cleanup, making you actively search for news headlines, tweets, or chart patterns that prove your trade is still good. The danger? You stop analyzing objectively. You're not evaluating the market anymore. You're defending your reputation to yourself. Recency bias, it worked before, so it must work again. If you've averaged down successfully in the past, even once, your brain gives that event way more weight than it deserves. You remember that one time it worked, but forget the countless times it didn't. It's like thinking you're a natural poker player because you won one lucky hand. In reality, the more often you try it, the higher the odds you'll hit the losing streak that wipes you out. Hope is a trading strategy, the most dangerous drug. Hope is a great human quality, but it's a terrible trading plan. When you're in a losing trade and averaging down, what you're often doing is replacing analysis with hope. It has to bounce becomes your thesis. But markets don't have to do anything. Hope feels good because it delays pain. But the longer you hold on to it, the bigger the pain when reality shows up. And here's the kicker. These biases don't happen one at a time. They stack. Loss aversion makes you avoid selling. The sunk cost fallacy tells you to add more. Ego keeps you from admitting you're wrong. Recency bias gives you false confidence. And hope glues it all together in a neat little package labeled, "This time is different." By the time you realize you're in trouble, you've got an oversized position, a blown risk plan, and a stomach that feels like you've just swallowed a bowling ball. Real-world blowups. Example 1. Averaging down trap. In 2022, a retail trader bought Apple stock at $175, right near the highs. A few weeks later, it dropped to $150. Believing it was a can't-lose stock, they doubled their position. When it slid further to $130, they doubled down again, convinced it had to bounce. But the slide continued, hitting $120. By then, their account was down nearly 80%. Yes, Apple eventually recovered, but the trader didn't. They had risked too much too quickly, without a plan, and the psychological damage of being that far underwater made it impossible to trade with confidence again. Example 2. The professional who should have known better. Even seasoned hedge fund managers get caught. In 1998, long-term capital management doubled down on bad bets in the bond market. When the market kept moving against them, the losses spiraled into billions, requiring a bailout. These were Nobel Prize-winning economists. Proof that brains don't immunize you from bias. The difference between strategic scaling and emotional averaging. Not all adding to positions is bad. The key is intent and rules. Strategic scaling, planned before entering the trade, based on clear technical fundamental triggers. Uses predefined maximum risk limits. Emotional averaging, down, done impulsively in reaction to losses. Justified with hope, not data. Risk grows beyond plan without clear exit. If your averaging down wasn't in your plan before you clicked buy, it's probably emotional, not strategic. How to break the cycle. Set a maximum loss per trade. Before you open a trade, decide the total dollar amount or percentage you're willing to lose, including all potential adds. If it hits that, you're out. No questions. Use position sizing rules. Never let one trade grow so big it can sink your account. Many pros cap a single trade at 1 to 2% of account risk. Build exit triggers into your plan. Use stop-loss orders or alerts. Pre-program your exit so emotions don't get the final say. Practice detachment. Remind yourself, the market doesn't care about you. It's not personal. Your job is to manage risk, not to win every single trade. Doubling down on a loser feels like taking control. But often, it's the exact opposite. It hands control over to hope, ego, and bias. Remember, your capital is your lifeblood. Protect it like a pro, even if it means taking a small loss now to avoid a massive one later. The goal isn't to win every battle, it's to stay in the war. Next time you're tempted to average down without a plan, ask yourself, is this a strategy or a rescue mission? If it's the latter, walk away. If this episode made you rethink how you handle losing trades, give it a like and drop a comment sharing your worst doubling down story. We've all been there. Subscribe to No Markets so you don't miss the next episode, where we'll uncover the overtrading spiral. Why more trades don't mean more profits. Remember, protect your capital, protect your mindset, and trade smart. Final line, cut the losers fast and you'll have more ammo for the real opportunities.